Hello options traders, welcome everyone. I wanted to post a video here talking about predicting index levels on the opening bell. And the reason is that in the past few weeks, because of all the market volatility we've been seeing, I've had some posts out there to the effect of, looks like the Dow's going to be in for a 300-point drop on the opening bell, or maybe a 500-point gap up on the opening bell. And I've had some new traders emailing and saying, how are you getting these numbers? And how can we be so sure of these predictions? What's going on here? Well, there is a way to do this, and that's what I'm going to show you in this video. But the main reason for understanding it is that a lot of new traders misinterpret the numbers. And they might see that the futures were down 500 points, and they assume that means that the market's going to be down on the opening bell. It might actually be up. So you have to understand what you're looking at. Otherwise, people tend to panic and they might start throwing in some sell orders before the opening bell, thinking they've got to get out of their positions. So there is a reason for understanding this. So let's take a look at how to predict the index levels on the opening bell and why it works. Here's a screenshot from CNBC, and just about any financial web page will have them. CNN has it, MarketWatch has it, just about all of them. And it's going to look something like this. You're looking at the Dow, the S&P 500, you'll probably see the Russell, the NASDAQ 100. I've just shot a couple of them here for you. But take a look down here on the Dow. It shows the futures market, which I'll explain a little bit, was trading for 24,082, down 506 points. This is a great example where a lot of new traders, their eyes pop out of their head and they say, I've got to just start placing sell orders before the opening bell because the market's going to come unglued. Not necessarily true. Down here, we see something called the futures fair value. And when we compare where the futures were trading, this 24,082, compared to the fair value, they were only down about 48 points. And that actually meant that it was basically a flat opening, a little bit down, but really nothing to get worked up over. Well, to do that, we have to go through a couple of definitions. And the first one is the cash market. And in the financial markets, the current price of a commodity or index is called the cash price. So if gold is trading for $1,200, the cash price of gold is $1,200. If the Dow closed at 24,000, the cash price of the Dow or the index level is 24,000. It just means what's that current level right now. And that's also called the spot price or the spot market. And it's really just a slang term because that's where you can buy it on the spot or right now. So if I say cash or spot market, it's just two different ways of saying the same thing. We also have another market called the futures market. And many of you have probably heard of the futures markets, but probably have never dabbled in it. Probably starting off with the options. Futures markets are actually easier than options, but because of the risk, the options markets are much safer. But futures markets are very easy to understand. And what they are is they're contracts, just like an options contract. It's a derivative contract. But the difference is, if you buy a futures contract, they are obligations. It's not a right like it is with an option. So if you have an option that's in the money, and for whatever reason you say, I don't want to exercise it, you're not required to. It's a right. Not true with a futures contract. With a futures contract, you have an obligation. So if you buy the futures contract, you'll buy the underlying for the futures price. And by the futures price, I mean whatever price where you purchase that futures contract in the open market. So in the options market, we have strike prices, but in the futures market, you just buy the futures contract. And whatever price you paid for that futures contract, you can think of that as your strike price. That's the price at which you will buy that underlying for. But you can also sell the futures. And if you sell the futures or short them, you will therefore sell the underlying for the futures price. But again, it's an obligation. However, like all derivative contracts, you can always get out. So how do you do it in the futures markets? Well, to escape your obligations, you will do so by entering a closing transaction. And that just simply means if you bought the contract, you will sell it. If you initially sold the contract, you will buy it back. That doesn't guarantee a profit. Your profit is determined by the price at which you bought and sold, very much like it is in the stock market or the options market. But the point is, if you do not want to take that buy or sell, you have to close it out with a futures contract. Now, interestingly, the cash and futures markets are tied together. I don't mean that physically, but they are mathematically joined. There's a mathematical relationship that must hold between these two. So you can think of them as they're kind of joined at the hip. They are two separate markets, but there's a certain relationship where they have to behave. So even though we're going to be talking about market indexes, to make the concept simple, we're going to look at just gold. And a true gold contract is for 100 troy ounces. Let's make it even simpler and say it's for 1 ounce of gold. So let's say that gold is trading for $1,000. And let's say we're also trying to figure out what a 1-year futures contract is worth. Is there a way we can do that? Well, let's take a look at some possibilities. You would certainly think it would have to be more than $1,000, the current price. But is it worth $1,010, $1,050? What if we think that gold is going to $2,000 in a year? Will that contract trade for $2,000? What's the fair value of this contract? Well, all financial assets have a fair value, and futures contracts are no exception. So the way you find it out is very simple. We're going to look at our gold price here at $1,000. That's the spot price. Let's say that interest rates are 5%. You're just going to take the current price and tack on 5%. So take your $1,000 spot price times 1 plus the interest rate, or 1.05. And that means the 1-year futures contract should be trading for $1,050, or what we might say is a 5% spread between the two, the interest rate, or a $50 spread. And that's what's called the fair value. Now notice I said it should be. So you can think of that as in quotes. That's always true for fair value. It's a should be type of a relationship. It is not guaranteed. And the reason is that futures markets are separate from the cash market. And the prices can drift from this relationship. They really have their own sets of supply and demand. So for some reason, the futures market might go drifting upwards and the spot market might be drifting downwards. But this relationship is going to push them back in line. So how is that done? Well, let's start with the first question. What if the futures contracts are trading for too high of a price? Our gold, we said in the spot market, is $1,000. Interest rate's 5%. But for some reason, the futures contract's trading for $1,060. Why? I have no idea. Just for some reason, had a lot of buying pressure out there, or we had some sellers back out, and the futures contract is trading for $1,060, or a 6% spread, or a $60 spread, even though we calculated it should be a $50 spread. Well, what's the deal here? What's it going to do? What will happen if we deviate from this fair value too much? It sets up what's called an arbitrage opportunity. And arbitrage is a really interesting concept in finance. And what it is a series of trades that are put on that guarantee a profit, but for no cash outlay. In other words, you don't even need your own money. It's like finding free money just lying on the ground. Now, sometimes you'll hear some websites say that arbitrage is a way of guaranteeing a profit, and that's really a little short-sighted definition. Why? Well, you could buy a bank CD. You got a guaranteed profit. That doesn't mean you're now a professional arbitrager. You could buy a T-bill. That's a guaranteed profit. Arbitrage is even more than that. You can get a guaranteed profit really for just putting on some trades, and you don't even need your own money. So if it sounds too good to be true, you are correct. But that only means that the arbitrage opportunity is going to be very short-lived. So there's going to be a couple of types of arbitrages that can exist. The first one is called cash and carry arbitrage. And here's what will happen. We have our 1-year futures contract fair value we said was $1,050. But for some reason, the 1-year futures is trading for $1,060. What we're going to do is we're going to borrow $1,000. Remember, we can't use our own money. Actually, we can, but we just need to account for the cost of carry. So you still think of it as though you're borrowing $1,000. And if interest rates are 5%, that means we are going to owe $1,050 in 1 year. So we're going to mark that in red. We have to pay that off at the end of the year. With that $1,000, what will we do? We're going to buy 1 ounce of gold. Remember, that's what it's trading for in the market. That's the spot price. But then we're going to sell the futures contract for $1,060. Remember, that's the current futures contract price. So if I go on my broker's platform and I go sell the current contract and I get $1,060 for it, it just means I now have the obligation to sell gold for $1,060 in 1 year. So as I said before, in the options market, we have strike prices. We don't really have strike prices with a futures contract, but you can think of that as your strike price. It's just the price where I executed my trade. And so in 1 year, I have to deliver 1 ounce of gold. Well, that's fine. I've got 1 ounce of gold sitting over here in my vault. But as soon as I do that, I'm going to collect 1,060 cash. That's the obligation from the person that bought the contract. I sold the contract. I'm going to get 1,060 cash. I'm going to take that 1,060. I will pay back my 1,050 loan. That's now off my books. And I'm left with a $10 guaranteed profit. Didn't even need my own money. And the reason that worked is because the futures contract was trading for too high of a price above fair value. Now, the most interesting thing is that this series of steps, these arbitrage steps, forces the spread back in line. So if the futures contract trades above fair value, as in this example, notice that we had to buy the spot market. We were buyers of gold. And then we sold the futures contract as a hedge. That's what allowed us to lock in this arbitrage profit. And again, it's these 2 steps right here that causes the spread to get back in line with fair value. So for example, gold was trading for 1,000. That was a spot price. 1-year futures contract was 1,060. But as we were going through for this arbitrage, lots of people were doing it, right? It's free money. Everybody's jumping in and buying gold. They're buying the spot market. And that's going to put upward pressure on that price. And to complete the arbitrage, everybody's selling the futures contract for 1,060. And that's going to put downward pressure on the futures price. And what does that mean? We're no longer going to have this 6% spread or this $60 spread. As gold prices keep rising and the futures contracts keep falling, we will eventually have a spread that's back to about 5% or fair value. So once again, it's the arbitrage that forces these relationships back in line. And once these relationships are back in line, the arbitrage relationships are done and the free money game is over. Well, what would happen if the futures price is too low? Let's take a look. Gold is $1,000, interest rate's 5%. But the 1-year futures, for some reason, is trading for 1,040. I have no idea why, just lots of people out there selling it. But now we have a $40 spread. That's the difference between cash and the futures market. Even though we said it should be 50, for some reason it's now 40. Well, we're going to just do the opposite. And yes, you guessed it, that's actually called reverse cash and carry arbitrage. Here's what will happen. The 1-year futures contract fair value was 1,050. That's what we calculated. But for some reason, it's trading for 1,040 in the market. What we're going to do is we're going to short 1 ounce of gold and receive $1,000. Shorting a commodity is done just like it is in the stock market. You're going to borrow it, you're going to sell it out there in the market as if you actually owned it, and you're going to receive the spot price. So now we've got $1,000 cash in our pocket, and I'm going to buy the futures contract for 1,040. And these 2 trades here in yellow are done simultaneously. That's important. That's what sets up the arbitrage. But keep in mind, we also owe 1 ounce of gold. So we're going to mark that in red and make sure that we have to pay this back. What comes next? We will deposit our $1,000 cash that we got from selling the gold in the open market. We shorted it. And we're going to receive 5% interest. So now we're going to collect 1,050 in 1 year. So after we go to the bank, we collect our 1,050 here. What comes next? Well, we're obligated to buy gold for 1,040. Well, fine. Take the 1,050 cash. In 1 year, buy gold for 1,040, which we're guaranteed to do because that's the price at which we locked in with the futures contract. We have 1 ounce of gold in our hand. We deliver it back to the broker, and we are then left with a $10 guaranteed profit. I collected 1,050 in interest from the bank, but I only spent 1,040 to deliver back the gold. And so it's free money for no cash outlay. And once again, reverse cash and carry forces the spread back in line. So what happened here? Well, if the futures contract trades below fair value, you want to sell the spot market. That will be important. And then you're going to buy the futures contract as a hedge. And again, that causes the spread to get back in line with fair value. The arbitrage undoes the benefit. So we saw gold here at 1,000, 1-year futures contract at 1,040. We said was a little light, was too low. What happens? To get the arbitrage profit, we sold gold. That's going to put downward pressure on spot gold. We're going to buy the 1-year futures contract, and that's going to put upward pressure on its price. And therefore, we're going to start moving from this 4% spread or this $40 spread back towards a 5% spread. And once that happens, the arbitrage is done and there's no more free money. But guess what? The futures contract is trading for fair value. Well, if you can understand that, that's exactly what happens with these indexes. It's just a lot more complicated. The S&P 500, we can calculate a fair value, and it would just be very complicated to do these arbitrages because you'd have to go and buy all of the stocks in the index in the right proportions, carry them, sell the futures contract, and do exactly the same steps. But it's all done by computer. So that's why I wanted to create a simple example, but the concept's exactly the same. So how would we figure out the fair value? Same way we did for the gold. SPX is trading for around 2,600. Let's say interest rates are about 3%. What should a 30-day futures contract be trading for? Take your 2,600 spot price. We're going to multiply it by 1 plus 0.03, or 1 plus the interest rate. However, in the gold example, we did it for a year, and that was to make the math easier. We're not holding this for a full year. We're only holding it for 30 days. So it's not really 3%. We have to multiply this 3% by 30 over 360. In other words, 1/12 of a year. You could also think of it as taking 0.03 divided by 12. And so once we do that, we multiply by 2,600. The fair value is 2606.50. Well, we're not quite done yet. There's also dividends you're going to receive if you end up buying these stocks. So we have to look at what's called the SPX dividend yield. And right now it's about 2%. So let's convert that to what are called dividend points. We're going to take the 2,600 index level times 0.02. That's just the index yield. And we get 52 points per year. But once again, we're not going to be holding this for a full year. We're going to take these 52 points and multiply by 30 over 360, and that's 4.33 points that we have to subtract for our dividends. Because again, if we buy the stocks, we will be receiving the dividends. That's money we get to keep. So the fair value of the contract then is the 2606.50. That's this number right here. And we subtract off 4.33 dividend points. That's that number right there. And we end up with a fair value of 2602.17. And that is the number that you have to keep your eye on. It's also critically important to understand that the arbitrage only lasts for a short time on the opening bell. I've heard some traders say, well, I saw the futures were down 500 points, so the market's going to be down all day. Not necessarily true. In fact, that might even be a positive indication for the market, which I'll show you why in a moment. But even if it is a down opening, it's just going to be a short period of time. And I'm probably being generous in saying this, maybe for the first couple of minutes. But the key takeaway here is to understand that this whole idea of being able to predict the market opening does not give an indication for the entire day. We're just looking at the first couple of minutes of trading. So let's go back to the screenshot that I opened up with, and you can see that the futures were trading for 24,082 on the Dow. They were down 506 points from their close. That is true. But the fair value is 24,129. So if the futures are trading at 24,082, they're only 48 points off of their fair value. What does that mean? Think of it logically. If the futures are cheap, what would you want to do? You'd want to buy the futures and sell the spot. It's going to be reverse cash and carry. Now, did you notice I said sell the spot? In other words, we're going to see the stock prices drop on the opening bell. Let's now take a look at it graphically and understand why you can get some very big misinterpretations in these numbers. First of all, understand that the index, the Dow, the S&P 500, NASDAQ, all these indexes close at 4 p.m. Eastern Time. But the S&P 500 trades for an extra 15 minutes. So it closes at 4:15 Eastern, so it kind of goes off on its own little set of supply and demand, but it can't be linked to the stock market. It's closed. So let's say that the index closes at this level, whatever number this is here in red. But for another 15 minutes, the futures start trading this way. And maybe there's big news. Maybe we were going into a big bull run into the closing bell. Market's reacting here, keeps going up. And here at 4:15, okay, so here's 4:15 p.m. There's the closing price. So this is the close of the futures right here. But There's a couple of little breaks, but essentially it trades all night long up until 9:15 a.m. the next morning. So let's say that through the night, the futures are trading down and they come way down to here. And you say, okay, the futures are down here. Here was the closing price. And I see there was a great big drop. The futures are down. Okay, that might be true, but they are still trading above fair value. What does that tell you? Well, if they're above fair value, they're too expensive, relatively speaking. So we'd rather buy the spot and sell the futures. That's actually a positive indication for the opening bell, even though the futures might be down dramatically. Let's take a look at another example. We'll do it from the downside this time. So here we are at 4 p.m. Eastern Time, and the index closes, but the futures market is trading down. Maybe there's negative information that came out in the markets, and at 4:15, they closed down here. So this is our 4:15 closing price down here. And through the night, they could perhaps continue lower, but let's just say, to make it interesting, that they reverse. And they start coming up, and so you get up the next day and you say, well, here's the closing price, and here's the current price right here, and we see that the futures are trading way up. That's what's showing on that screen. Futures prices might be up 100 or 200 points on the Dow, or 5, 10, 15 points on the S&P. It doesn't really matter. Why? Because we are still trading well below fair value. And that means that the index is cheap, so we should buy the index, and we would therefore want to sell the spot market. So notice that even though the futures are trading up, perhaps even well up, if they are trading below fair value, it still sets up reverse cash and carry arbitrage. You're still going to see a negative opening on the bell. All right, let's try one more to make sure you got the concepts. Here's a little quiz for you. Market closes at this level, and after the closing bell, S&P starts taking off, closes way up here. Here's our 4:15 closing price. And through the night, maybe it's trading way up or down, and on the opening bell, we see this very big drop. And that drop is measured from the closing price to its current price. Right here, we see a big drop in the futures price. What does that tell you? Doesn't really mean a whole lot. Why? You're trading just about fair value, and that means market's going to open up flat. So hopefully you see why it's important to understand all of the nuances in the market before you start placing those trades. And understanding how to predict index prices on the opening bell is a really important part for successful trading. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.